At the opening of U.S. trading today, something unusual happened in the silver market. Not on television, not on social media, and not in the headlines. It happened quietly inside futures positioning, order flow behavior, and how price reacted when it normally shouldn't have. This wasn't noise, wasn't hype, and it definitely wasn't retail excitement. It was a signal. The kind of signal that appears before markets reprice, not after. This video is not financial advice. This is a market structure briefing. Because when silver behaves like this, it's not optimism driving the move, it's pressure. Here's what matters. Silver has spent months trading in a narrow, controlled range. Volatility compressed, rallies capped, sell-offs contained. But markets don't stay quiet without a reason. Periods like this usually mean one thing. Positions are crowded and liquidity is thin. Today, that tension showed itself. During early U.S. hours, silver absorbed selling pressure that, historically, would have pushed price sharply lower. Instead of breaking, price stabilized. Instead of accelerating down, it paused, and then held. That behavior is rare. Normal conditions, aggressive selling creates immediate follow-through. Stops. Trigger. Momentum builds. Algorithms do what they're designed to do. But today, selling didn't behave like selling. It met resistance. That's the first warning sign. When price stops responding to pressure, it means supply at those levels is no longer freely available. Someone is willing to take the other side, size for size, without demanding a discount. This is not how markets behave when shorts are comfortable. Silver is one of the most structurally shorted commodities in the global system. That's not opinion. It's reflected in futures positioning, leasing markets, and the sheer volume of paper claims relative to physical supply. Most of the time that structure works. Short positions roll. Liquidity masks. Imbalance. Time does the work. But structures only function while confidence holds. What we're seeing now is confidence thinning. Not panic. Not capitulation. Preparation. Short squeezes don't begin with price explosions. They begin when price refuses to go lower. That's where silver is right now. And price is only the surface layer. Underneath it, physical availability has been tightening for years, not collapsing overnight, but draining steadily. Industrial demand has remained resilient. Recycling hasn't filled the gap. New supply hasn't responded the way models predicted. Silver isn't just a precious metal, it's a consumed material. Once it's used in electronics, solar panels, medical equipment, and defense systems. It doesn't flow back easily into the market. And yet, the paper market has always treated silver as if supply were elastic. That assumption only holds until delivery matters. What makes this moment different is timing. We're seeing this behavior while inventories are already strained, industrial demand remains elevated. Geopolitical risk is rising, and capital is reassessing counterparty risk. That combination changes how leverage works. When shorts realize they can't push price anymore, they don't wait for headlines. They reposition quietly. And that repositioning is what creates the squeeze. Not all at once. Not visibly at first, but structurally. This is the phase where most people stay calm, because nothing dramatic has happened yet. But markets don't reprice at the moment of recognition. They reprice at the moment of realization. In part 2, we need to break down where this pressure is coming from. Why this setup is different from past false alarms, and why the short side of the silver market is suddenly far less comfortable than it appears. Because when structure changes, price eventually follows whether the crowd is ready or not. To understand why this signal matters, we need to talk about where stress is building, not where headlines are pointing. Because silver doesn't squeeze the way stocks do. There's no viral frenzy. There's no sudden crowd rush. Silver squeezes happen quietly inside supply chains, inside hedging desks, and inside decisions that never make the news. The first source of pressure is supply. Silver production is not as flexible as many assume. Most silver isn't mined on its own. It's produced as a byproduct of copper, lead, and zinc mining. That means silver supply doesn't respond quickly to silver prices. If silver doubles tomorrow, miners don't suddenly double output. They can't. New projects take years, permits take longer. Many producing regions are already dealing with regulatory pressure, higher costs, and political uncertainty. So when demand rises, supply doesn't rush to meet it. The imbalance simply grows. The second source of pressure is industrial demand, and this is where silver is different from most precious metals. Silver is essential. It's used in electronics, solar energy, medical technology, and advanced manufacturing. These industries don't buy silver because it's cheap, they buy it because they need it to function. And when supply tightens, they don't wait for price confirmation. They secure material first and worry about cost later. That behavior doesn't show up immediately in spot prices. It shows up in procurement patterns, longer contracts, and reduced availability for everyone else. Which brings us to the third source of pressure, inventory. Global silver inventories have been trending lower for years, not collapsing overnight but steadily declining. Small deficits repeated annually eventually become large constraints. This kind of imbalance is dangerous because it doesn't announce itself. Markets can operate normally right up until the moment they can't, and when inventories are thin, leverage becomes fragile. This is where the paper market comes in. Silver trades in enormous volumes on futures exchanges. Far more silver changes hands on paper than exists physically. That system works as long as most participants are confident they won't need delivery. But confidence is not permanent. When even a small percentage of participants begin to care about physical settlement when they prefer metal over contracts, the system tightens fast. That's what we're starting to see. Not panic, not headlines, but subtle shifts in behavior. Short positions are becoming more selective. Volatility is compressing instead of expanding. Price is absorbing pressure instead of reacting to it. Those are not signs of a healthy, balanced market. They're signs of a market where liquidity is thinning on one side of the trade. This is why the term short squeeze is often misunderstood. It's not about shorts being evil. It's not about manipulation. It's about math. When too many positions depend on easy liquidity and that liquidity disappears, adjustment becomes unavoidable. And the adjustment doesn't happen gradually. It happens when someone decides they can't afford to stay exposed. That's the phase silver is entering now. Up to this point, the silver market has been able to balance itself through one assumption, that financial demand and industrial demand wouldn't collide at the same time. That assumption is breaking. Silver is not just stored, it's used. And when industrial buyers enter the market with urgency, they don't behave like investors. They don't wait for dips. They don't trade charts. And they don't care about sentiment. They care about continuity. Factories don't slow down because silver prices are inconvenient. Supply chains don't pause because futures markets are volatile. They secure material quietly, early, and often off-market. This is where pressure starts to move backward through the system. Industrial demand for silver has been rising steadily. It's driven by electronics, renewable energy, and advanced manufacturing. But what matters more than volume is priority. When availability tightens, industrial users move first. They lock in contracts, they pay premiums, they bypass exchanges. That silver never reaches public markets. And when enough material is diverted this way, the paper market loses its buffer. This is why premiums matter more than spot price. You can have a stable chart and a stressed supply chain at the same time. That's not a contradiction, it's a warning. When physical silver becomes harder to source, refiners prioritize long-term partners. Mints reduce output. Dealers quote longer delivery times. None of that shows up immediately in futures prices. But it changes behavior, and behavior is what breaks structures. The paper silver market depends on confidence that contracts can always be rolled, settled, or offset without friction. But when physical availability tightens, that confidence erodes, slowly at first, then all at once. This is when spreads begin to matter. This is when delivery terms get attention. It's when holders start asking a different question. Do I want exposure or do I want metal? That shift doesn't require mass participation. It only requires enough participants to stress the system. History shows that when financial and industrial demand overlap, silver doesn't adjust smoothly. Gaps. Because price is no longer balancing buyers and sellers, it's rationing supply. This is the environment where short positions become dangerous, not because of price spikes, but because exit paths narrow. Liquidity disappears on one side. And when that happens, the market doesn't wait for consensus. It forces repricing. What we're seeing now, compressed volatility, resistance to selling, tightening availability, is consistent with the early phase of that process, not the climax, the setup. Now the setup is clear. Supply is tightening. Industrial demand is competing with financial positions. Shorts are uncomfortable. Volatility is compressed. This is the moment where most investors hesitate, waiting for confirmation, waiting for headlines. But markets don't wait. Decision points happen quietly when physical silver becomes unavailable at expected prices, when paper positions cannot be rolled without friction, when delivery premiums widen, and insiders begin to lock in supply. Every one of these points signals a market that is coiling, gathering energy to release. A short squeeze doesn't start with a spike. It starts in the plumbing, in inventory behavior, in spreads, in lease rates, in industrial allocation. And right now, that plumbing is showing strain. For new entrants, the danger is waiting too long. By the time the crowd reacts, the structural shift has already redistributed risk and control. For those already positioned, patience is key. This is a test of timing, not timing panic. Silver is moving quietly, invisibly behind the charts. The question isn't if the squeeze will happen, it's when, and who will be on the right side when it does. Watch the signals. Observe delivery behavior. Track spreads. And understand that the market doesn't care about headlines, it cares about structure. This is not hype, it's market mechanics. And the signal just flashed. Your move is to decide. Watch, prepare, or act. But do not ignore it.